huge sums of money have shifted to the non-bank sector. You were talking about a shift of tens of trillions of dollars. And a factor in all of this is leverage. The more levered they are, the more that amplifies the shock.
A big issue is just that we don't even have the data. So we don't know, maybe it's not bad at all. Maybe it is bad. We don't know the risks at all.
People always tell us, oh, trust us, we're taking care of it. We would never be caught, unawares. But financial firms are always caught unawares. Every time we have a crisis or a period of turmoil, it's because some firm that thought they were doing things prudently turns out not to have been doing it as prudently as they thought.
This episode of Monetary Matters is brought to you by VanEck's semiconductor ETF, ticker SMH. As you may know, SMH is the largest semiconductor ETF by AUM, with over $25 billion in assets under management. But what you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that's been intelligently designed to capture low-capex, high-margin chip designers, setting the next stage of AI. You'll hear more about both later in the show. Let's get into it. Today, we've got a very special conversation. I am joined by John Schindler, General Secretary of the Financial Stability Board. The FSB plays a critical role in safeguarding global markets and is hosted by the Bank for International Settlements, or BIS, in Basel, Switzerland. John, during the global financial crisis, was seconded to the U.S. Treasury Department as Chief International Economist, and he was seconded to the FSB Secretariat from 2015 to 2016. John, welcome to Monetary Matters.
Thanks, Jack. Thanks for having me.
We could talk about a lot of things. The FSB comments on many things, climate risks, stable coins, but you just had a report out on from the Financial Stability Report on NBFIs, non-bank financial intermediation, and specifically leverage in non-bank financial intermediation. What motivated you to write this report?
This is a report that's been a long time in the making. Since the FSB was created, non-banks have been a focus of the attention. We've done work on what was then called shadow banking and a lot of work over the years. During the market turmoil, the dash for cash in 2020 at the onset of the COVID pandemic, we learned a lot about how market dynamics had changed. And we identified some work that we were going to do over the next several years. And the final piece of that was looking at leverage in the non-bank sector. So the borrowing by non-banks that can, in times of market stress, unwind. So because various periods of turmoil have taken place, including that dash for cash, there have been various episodes where non-bank players during stress have gotten rid of or unwound that leverage, and that has caused spillovers to other parts of the market. So that led to us to study the non-bank leverage, to look at ways in which we could potentially try to address that. And that led to these recommendations, which we just released.
And what are we talking about when it comes to non-banks? So before the Great Financial Crisis, you can give me numbers, but a greater percentage of lending against assets in the real economy as well as in the financial economy was done by banks. The regulatory apparatus, Financial Stability Board, BIS, Federal Reserve, go down the list, has strengthened its control and regulation of the banking system. So a lot of those risks have moved outside to the non-bank system. And you call some of that regulatory arbitrage. Basically, the non-bank sector is doing things that it would be regulated in the banking sector, but now it's less regulated or maybe not regulated because it's in the non-bank sector. But I'm just trying to, for me and for the audience, kind of get my hands around what are we talking about here? Because as you note in the report, the non-bank financial intermediation, NBFI, is very heterogeneous. So what are we talking about? Are we talking about hedge funds? Are we talking about private credit, making leveraged loans that used to be made from the banking system and now are made by Ares, Apollo, and many, many other entrants into the private credit game, or something else? What are we talking about here?
Right. Very simply, I would say that in the financial system, we often say banks and non-banks, and then non-banks is this amorphous term that covers a lot of stuff. It's very heterogeneous. I gave a speech on that last year, I think at Eurofy, that people could look at. But when we talk about it, we're talking about all of the non-banks. We're talking about insurance companies. We're talking about the whole fund industry. So if you want to talk about open-ended funds, what we would call mutual funds in the United States, money market funds, hedge funds, family offices, broker-dealers, a wide range of institutions. They're all very important. They're critical to the financial system. But we've seen in periods of turmoil, like I've said, that their unwinding of leverage has led to spillover effects recently. So non-banks is just a general term that covers a lot of things. And we're not saying that all of them use leverage in the same way, but they're all using leverage. They've all been important in recent periods of turmoil.
And what is your focus in terms of, I guess, maybe the greatest concentrations of risk or the greatest rate of change of risks, that there weren't that many risks in X field 7 years ago, but now, wow, it's maybe a lot more risky. What are we talking about here?
Well, maybe I can take a longer term perspective. You alluded to some numbers. We put out an annual report that tries to size the non-bank sector. Global financial crisis comes, banking, it tends to be bigger than non-banks globally for our members. Regulations are put on banks to try to make them more safe and secure. So there's a natural move. You referred to it as regulatory arbitrage. We can call it arbitrage, or we can just refer to it as a natural response. Okay. So now globally, banks and non-banks each are roughly 50% of financial intermediation. So it went from something like 60-40 to 50-50. Now, 60-40, 50-50, that doesn't sound like a lot. But when you're talking about global financial intermediation, you're talking about a shift of tens of trillions of dollars. Huge sums of money have shifted to the non-bank sector. So when we're talking about the changes that we've seen and why we're thinking about this now rather than then, it's because of that shift. And because during periods of turmoil, we're seeing non-banks play a bigger role than they did 15 years ago, something like that.
Where do you think is a good place to start?
We could talk about the recommendations more broadly.
Sure. So let's talk about the recommendations. What do you recommend? I think you had 9 recommendations. What were they?
I would say that if you think of them collectively, they first encourage authorities to go out and look at their own non-bank sector. Every non-bank sector is going to be different. If you look at the United States, if you look at England, if you look at Japan, if you look at Indonesia, India, all FSB members, everyone is going to have a different non-bank sector. So for that reason, the first thing is for the authorities to go out and do a careful risk assessment of the non-bank sector and determine what are the core financial markets that non-banks are operating in and what sorts of risks or vulnerabilities are developing there. So that covers a few of the recommendations. And then the question is, how do you go after that? If you've identified that in our core financial markets, that could be like your sovereign bond market, it could be your corporate bond market, it's wherever they're using risk. What are we suggesting that authorities do? And then we outlined a number of types of measures. And the ones that have gotten the most attention are sort of activity-based measures and entity-based measures. An activity measure might be if somebody's engaged in a particular activity where they're going to take on leverage, we want to ask them to put up a little bit of money in the first place to sort of safeguard against when things go bad. An entity-based measure might be an authority in a country might say, we want you to have a limit on how much leverage that you take on. So this is all general. I haven't spoken about a particular type of institution or activity yet. I've just sort of said authorities should go out and make this assessment. And once they've assessed that, here's a variety of tools that they can use in that case. So those are some of the, again, I haven't gone through all of the recommendations. I'll leave that for readers to dig into, but that's a few of the things we've asked them to look at.
And a lot of the recommendations centered around the issue of disclosure. And this is an issue that I know in private credit is particularly an issue, because the Federal Reserve on any bank, the SEC, can just go into a bank, get all the data they want. But if you look, what first struck me is I read a Federal Reserve report about private credit. And normally Federal Reserve reports are incredibly, obviously very, very intelligent, but they also have a basing of a ton of data, like any available data. But I'm reading this private credit report, I'm like, whoa, they don't really have that much data. And then there's the IMF report came out last year, 2024, about private credit. They had them said, whoa, they've got a lot of better data. Then I talked to the guy who basically was overseeing that team at the IMF, who wrote that report, Fabio Nattalucci. I interviewed him a month or two ago, turns out you actually know him when you guys worked at the Federal Reserve or the Treasury. You correct
That's right.
me. And then, so just a big issue is just that we don't even have the data. So we don't know, maybe it's not bad at all. Maybe it is bad. We don't know the risks at all. So just, talk about the opacity, and are players in the space, do they kind of benefit from the opacity? Are they pleased with the status quo where the FSB, the BIS, the Federal Reserve, the Treasury, the SEC, the CFTC, they don't really know what's going on, and they're pleased with it?
First, yes, Fabio and I worked together for a long time at the Federal Reserve, so I'm glad you're talking to him. Quite knowledgeable in this space. Um, in the non-bank space, it's not fair to say that we don't have anything. Even I think the Federal Reserve Board, they put out their financial stability report twice a year. You'll find information, for example, on hedge funds in there or hedge fund leverage, although the data will often be 3 to 6 months old, and it doesn't have that fine level of detail that you would have for the banking sector. So I don't want to accuse them of not having any data. I don't want to say that this industry doesn't have or that industry doesn't have data, but the level of data collection is different in the non-bank space. I'm making broad generalizations. Um, and it's also, in general, collected for different purposes. For banks, there's this micro-prudential set of regulations and data collection, so to make sure that they are safe. And then because a lot of banks are regulated by central banks or authorities who have financial stability authority, there might also be data collections to get at financial stability issues. This could be asset valuations, liquidity mismatch, maturity transformation, leverage. But the regulation of the non-bank sector is often not done with financial stability purposes in mind. It's more of an investor protection purpose. So they want to make sure that, if something bad happens, investors have the proper amount of disclosure. And so the regulation about the reporting requirements is different for the non-bank sector. So that leads to a level of opacity in terms of financial stability authorities being able to identify vulnerabilities. So absolutely correct. But again, I'll probably have to say this a lot today. The non-bank sector is not one thing. There is different reporting requirements for all those different pieces. Some pieces would say, hey, we already report enough for your purposes. Others, well, hopefully they would say, I'm sure that you'd like some more information from us, but we're not going to give it to you.
And where would you say the data opacity or the lack of data is most glaring? You referenced the Federal Reserve's got some data on hedge funds. They release it even though it has a 3 to 6 month lag. Would the most glaring data lack be in private credit?
That's a good question. It's going to vary from country to country, jurisdiction to jurisdiction. I should say in the United States, it's the SEC that collects the data, and some of that data is shared with the Fed in this case. I think broadly speaking, there are sort of the private industry, the private finance in general. You're saying private credit, but private equity as well. The hedge funds, there is some collection in the United States, for example, by the SEC and other jurisdictions. There is some collections. But as I mentioned, that collection is often not done with financial stability purposes in mind. It might be an investor protection purpose. So you might collect different data in those cases. So in general, I would say it's in that area. You have things like open-ended funds where you might know all of their assets on a periodic basis. So you'd be harder to argue that there's not sufficient data collection there. Insurance companies have certain reporting requirements. So it's going to vary country to country and industry to industry. There's been a lot of attention on hedge funds. There's been a lot of attention on different types of hedge funds. And that, I think, is where a lot of regulators who have a financial stability mandate feel like they don't quite have the insight that they need, especially given the size and the activities that they're involved with.
And earlier you said some firms, maybe the US, focus on investor protection, not financial stability. I think that issue is very relevant in family office, because if the only issue that mattered was investor protection, like some retired 68-year-old, a fund manager who wanted to hire a bunch of analysts and traders and speculate on assets all around the world, that doesn't really matter. He's fine. 68-year-old, he's fine.
Yeah.
But you're saying the issue, no, if he loses all of his money, it's not, we're not trying to protect him. We're trying to protect the system, because his team is speculating on interest rates and they have a 50 to 1, 100 to 1, 300 to 1 leverage position, and that itself is causing a risk to financial stability, right?
So I think the spillover effects are what have caused concern in recent years. Any of the episodes that the dash for cash that I mentioned, or during the Russian invasion of the Ukraine, there was some market turmoil in some commodity markets, and we've seen episodes like this, including Archegos, which is one we've already mentioned. When those things happen, if they're isolated and stay in their market, then that's not so much a financial stability effect, so long as the market continues to price things. But sometimes the market doesn't function. You can't get a price. People can't buy or sell anything. So then you get these fire sales. People dump things. I'll take whatever price you can give me. And you say, oh, well, the person who is invested in that hedge fund, they're the one taking losing money there. So why am I concerned about it? Well, I have a mother who's 80 years old and she's a retiree and she's got a fixed income and investments. And when her portfolio takes a 13% hit in 7 days and she calls me up and says, what's going on? I thought you're supposed to be working on financial stability. And why did I lose all this money? My mom is not invested in hedge funds. My
Mhm.
mom is invested in, your typical retirement accounts. But the spillover effect of, an unwinding of a leveraged position, which led to a fire sale, which led to a market sell-off, that's the sort of thing that has repercussions beyond the investors in that hedge fund, or beyond the people in the open-ended fund who sold an illiquid open-ended fund to get out of it quickly.
Let's talk about how that leverage played out during March 2020. So you had a huge recession. It turned out only lasted 1 to 2 months, but it was a huge recession. So it makes sense that the stock market crashed. But often, during recessions, the bond market actually does quite well. But there was a time when the bond market was selling off too. What vulnerabilities were revealed during that episode, and how does it relate to the high amounts of leverage in non-bank financial intermediation, but also maybe the opacity as well?
There was a lot going on in March 2020. Obviously, there was a huge reevaluation in everybody's mind of what's going to happen to the global economy. We didn't know how long the recession would be, how long it would last, how deep it would go. Uh, so we call this the dash for cash, or that's one of the terms that is applied to this period, because one of the things that everybody wanted to do is it's safe to hold cash. So let me do whatever I can to get cash. If I've got U.S. Treasuries or Japanese bonds, let me sell them. Let me get the cash, which is okay. That sounds prudent. But when everybody tries to do it at once, when everybody's selling at once, the price of everything goes down. And it's not like they were selling this asset to buy this asset. So one was going up. All they wanted was cash. Cash was king. So unfortunately, in times of stress, if you think of liquidity, there's a market for liquidity. Sometimes the demand for liquidity goes up, so the price of liquidity or maybe an interest rate goes up. Sometimes the supply of liquidity goes down because nobody wants to offer that liquidity. So just like any other market, there's a supply and demand for liquidity. And what we saw was the demand for liquidity spiked, the supply of liquidity fell. There were a number of factors. The FSB has been working for 5 years now on trying to mitigate those factors. We looked at things like the open-ended funds, the money market funds, and the fact that people use them as tools to sell out and to get the liquidity. We looked at the margining practices. People have to put up money to make certain investments, and those margin calls are big, and they didn't have the cash on hand. And a factor in all of this is leverage. The more levered they are, the more that amplifies the shock because they have to sell off more to get to the money to pay back. So all of these factors, liquidity went way out of whack. The liquidity market went way out of whack. And so you have to deal with the demand there. You have to deal with the supply. Leverage amplifies all of that.
What did money market funds have to do with that?
Sometimes you want to get cash quick and it's as close to cash as you can get. So if I want cash, I'm going to sell my money market fund shares, or in some cases you might move money into the money market fund shares. But if you're selling the money market fund shares, perhaps because you're worried about the underlying investments, perhaps because you just needed cash and it is such a readily convertible into cash investment, it's a dash for cash. I'll do whatever I can to get cash.
And those money market funds, some of them owned, super safe treasury bills, but some of them also maybe were a lender in the repo market where the big hedge fund market were borrowers in order to arbitrage the basis spread, and that blew out, right?
So there are some money market funds, and money market funds are a
Mhm.
diverse group, even amongst themselves. Some of the money funds invest in government bonds. That's probably the safest ones, and they can buy and sell the US treasuries or the underlying European bonds or Japanese bonds, whatever they're holding. Others invest in other things that are maybe a little bit less liquid. Maybe they're in commercial paper or something where the secondary market isn't great. So it's short term. So you're usually just holding it for one day, overnight, 7 days, something like that. So some money market funds can get in and out quickly. Some have a little bit harder time dealing with a high level of redemptions.
Was the epicenter of that crisis not the broader financial crisis or COVID or anything, but just particularly in the government bond market? Was it that basis trade where, let's see, cash bonds yielded maybe slightly more than futures, so the big huge hedge funds would sell the futures and buy the cash bonds and lever that up a ton by borrowing in the repo market, and that repo market fund, was it the repo market funding that dried up? Was it the bond market selling off? What caused that cycle of illiquidity?
This is one example of a trade that people might unwind when there's a period of stress. So the basis trade tends to be a very safe trade in general. And when interest rates move the way people expect them, then it works, and they get to arbitrage this spread that's there. Because that spread tends to be very small, the only way to make a lot of money on it is to leverage that up using the repo market, like you've just said. So maybe they leverage it up 50 times, 100 times. I've heard stories of people doing 450 times. I don't know exactly how much individuals might lever up in there. But when things move against them, if they move the opposite direction in a significant way, they can probably handle, they're probably testing their own portfolios against moves of a certain size. The COVID shock was bigger than anybody expected, which meant interest rates or expectations about interest rates moved more than anybody expected, which means that they had bets that were bigger than they had anticipating having to lose money on. So then they close out their position, which usually means they're either selling off the bond or the derivative on the other side of that, depending on which way they've bet, which means there's going to be tremendous selling pressure on one side of that, depending on which direction things have moved.
Hope you're enjoying today's episode. Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC, through the equipment makers and software developers. Its market cap-weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHJack to learn more. Building on the design and success of SMH, VanEck saw an opportunity, and it launched a fabless semiconductor ETF, ticker SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimizations and applications at the edge. Go to vaneck.com/SMHXJack to learn more. And now, back to the interview. And where does clearing come into that? I know that's a very important thing, and that the Federal Reserve is moving for more centrally cleared things. Why is that important?
I think central clearing is viewed as, suppose I have two people interacting bilaterally, and then one of them is having trouble. That is going to spread to the other person, right? Because, thank you for lending me that money. I'm having a little bit of trouble giving it back to you right now. And now this person all of a sudden doesn't have the money that they want, because they're all trying to get cash at the same time. With central clearing, you don't have that same bilateral connection. You have somebody in the middle who is taking all the positions and sort of making sure everybody gets paid out. And so if I've got 10 positions with everybody and they net everything, and so that I bought with you, I've sold with you, I'm netted zero, so that's all good. So that central clearing tends to make things a little bit better and neater, and some of the positions get aggregated. Maybe somebody's aggregated to zero. So it's good to have that central counterparty in the middle. So that's one thing. There's still risk there. I mean, there's somebody running that organization, and sometimes the strains might get too much on them. We do stress testing for these financial market utilities as well, and that's not my expertise, but I'm sure there are ways in which somebody could tell us how we could break them if we stress them just enough.
John, before we get into more individual markets, I want to ask you, a thought I had when reading this report is, and I want to see if I can explain myself clearly because it's kind of a weird analogy. But that, let's say you had, like, if you have four kids and there's one kid who's a problem child. Tommy, don't throw rocks at your neighbor's window. You don't say, Tommy, don't do that. You say, kids, make sure you don't do this. You address everyone. Praise individually, criticize by category, right? A thought that went through my mind when I was reading your report is the United States like the bad kid, but you don't want to single anyone out, but you just you say, everyone around the world, they got to do their thing, and regardless of where you are, Africa, Asia, Australia, Europe, United States, you got to make sure that you're not building up too many risks.
Mhm.
But as people can tell from your accent and my accent, we're both American. You're in Basel, Switzerland. Like, because I know, I mean, maybe I'm biased because I'm in America, but I see a lot of the leverage activities and speculation, and is based in the US of A. So, just, is there any accuracy or truth to my premonition, or am I off base?
So first, I have to sort of break into a personal anecdote. You said four kids, including Tommy. I actually have five kids, and the second oldest is Thomas, and he's actually getting married next week. So funny that you chose that personal combination. Um, I mean, U.S. financial markets are the largest globally, and people can throw out numbers. Think capital markets. There's something like 50% of market capitalization. I don't know the exact numbers, but this is not a U.S. phenomenon. Some of the episodes that we mentioned, the Dash for Cash was a global Dash for Cash. The LDI episode was a UK oriented episode. There was the Japanese yen uh, period of turmoil. That's about a year ago now. Um, Archegos was not a US phenomenon. Some of the biggest lenders were European lenders. So this is not a US phenomenon. Now, the US is the biggest financial market. So, yes, they have a big role to play there. I think some of the largest hedge funds are domiciled in the United States. Or so, in that sense, yes, but this is not singling out one child and saying, I'm really upset with all of you kids, but it's really you, something like that. So, no, I wouldn't say it's quite like that. I wouldn't characterize it that way.
Okay, okay. And so, tell us about the September 2023 gilt market panic when the British sovereign bond market, there was a lot of forced selling. It had to do with insurance, liability-driven investments, pension funds. What exactly happened there? What were the learnings, and how can we be better prepared for a potential event like that in the future?
Liability driven investments, so your insurance companies and your pension funds, they're funded in a certain way. um, just like anybody, they have prudential measures in place, so they're going to look at a lot of what they hold are you know debt instruments, and so the interest rate is really important there. And so they're going to test themselves, like what happens if interest rates move by 100 basis points. What if they do that over a course of a month or 2 months? But the movements that we saw in the gilt yields were so large that they were beyond what anybody had tested for, which meant that they had taken on certain positions, and when those positions moved by too much, they had to sell some of their positions to, you know, get the cash or to pay back the person they had borrowed from. But because those movements were so large, they just hadn't anticipated that. So I think that, and somebody from the UK financial authorities could come in and tell us exactly what the steps were that the Bank of England, the FCA took to sort of prevent them from taking such large positions in the future, um, so that they won't have to have this rebound effect if interest rates go beyond what they did in their own internal stress testing.
John, when it comes to insurance companies, how are you thinking about risk? Because in the banking world, everyone's leveraged, and everyone basically, you can, call their money at any time. There's certificates of deposit, but whether it's in the repo market or literal depositors, people can just call their money. And that's why banks are inherently risky, and deserve the scrutiny that they receive from regulators. So I think it's a good thing that they are quite heavily regulated. And I'm sure you agree with me. But what about insurance companies? Because, like, if you're, if I have an insurance company and I got a bunch of 50-year-olds, and I, sell them a life insurance policy, they're not all going to demand cash at once. I'm Geico, I'm Progressive. No one's going to crash their car all at once. Um, Obviously, I guess if you're selling policies that you assume aren't correlated, and there is a correlation. Like, if there's a hurricane everywhere around the world, that at the same time, that would be an issue for property casual markets. But basically, the issue is, and I talked about this with Fabio Nannalucci, is that there's not a run. No one can. I can't call Allstate and say, "Hey, give me my money back." Allstate only is going to give me my money back if I crash my car.
You're absolutely right. Insurance companies are different from other parts of the banking sector and the non-banking sector. The run risk is not there to the same extent it is in other places. I think there are some people who've looked at like variable annuities. So there are things that are not insurance contracts. It's not your home and auto insurance, your life insurance. But annuities might have some run risk, but I don't know if people assess that to be very high. So there could be other things that they're doing. So you might ask, well, what do they do with all this premium money? Obviously, they're investing it. They will tell you they have a very predictable loss model. So could something throw that off? Some people assert that climate change could throw that off because there might be non-linearities in climate change. So their losses might change dramatically. Some people have pointed to the fact that some insurance companies no longer insure certain types of property. So there's a sort of hole, a protection gap opening up insurance. This property is not insurable. Okay, so that could also be something. But then if you think about what do they do with that money? They could be putting it into a lot of places. One of the things they're doing now is private credit. Most people think, oh, if I want to get a loan, I've got to go to a bank. A bank will give me a loan. But banks have become more careful. I talked about that shift in intermediation. One of the groups that has helped pick up the slack, gone to these borrowers who are no longer getting the credit they want, are insurance companies. They have a huge source of income. The premiums that are being paid, they want to invest it. We've gone through a period when interest rates were very low for a long time. They were looking for alternatives. One of the things that they turned to was private credit. Insurance companies aren't alone there. Other firms have done this as well, but that's a shift. I'm not saying that this is going to break insurance companies, but it is something that is a shift. We haven't been through a full financial cycle. We don't know what's going to happen if the financial cycle goes into a downward turn. Have the insurance companies prepared properly? And then here again, as a financial stability authority, we don't have the same level of transparency from the insurance companies that we do from the banks. It's harder for us to say, well, what are you invested in? How quickly can you get out? How liquid is that investment? So those things are harder. So that's not a comprehensive assessment of insurance companies, but that's some things that are on people's minds.
Right. And publicly traded insurance companies, they do report in their annual reports. They break down credit rating, duration, what percentage is asset-backed securities, treasuries, municipals, et cetera, et cetera. To what degree is that sufficient versus not sufficient? What's the information that, hey, Progressive, we need this information. I understand you told your shareholders this, but we need XYZ information that you don't have.
Well, I mean, for one thing, you've already highlighted the frequency. If the report is annual or even quarterly, if you think about a shock to the economy, something happens tomorrow, not predicting anything, but something happens tomorrow, and all of a sudden people want to know, well, how is this going to play out in the system? Knowing what you had and what your duration was 6 months ago, 9 months ago, 2 months ago might not be the most relevant fact. I think I mentioned Form PF data that the Fed reports on hedge funds. When they release that sometimes in their financial stability report, it's almost 6 months old. Knowing how leveraged hedge funds was 6 months ago is not the most relevant fact to how things are going to play out today, because they don't sit there and just do nothing. So if I want to know what's going to happen, I need the data in a timely fashion, and I need it in a granular fashion. If Archegos blows up, if Credit Suisse experiences trouble, and I want to know who's exposed, I'm not going to have that information from a lot of the non-bank players, insurance companies, hedge funds, etc.
And I think, correct me if I'm wrong, that the great financial crisis was caused a lot by players that actually were technically non-bank in the U.S., as in not regulated by the FDIC, non-depository. So Goldman Sachs, Bear Stearns did not have mom and pop depositors, and also a lot of the subprime mortgages were made by also institutions that were not banks as well.
That's right.
However, the banking sector was very tied up with that. So, after the great financial crisis, or maybe during, Goldman Sachs converted to a bank, and everyone thinks of Goldman Sachs as a bank. Whereas versus now, is it the non-bank players that are, having some data reporting issues and are kind of doing a lot of the activity, they're nowhere close to a bank. They're insurance companies, private credit firms, alternative asset managers, and the hedge funds and the like. Not things, it's not like JP Morgan also has this department, right?
So there's a lot of complex financial institutions out there. So understanding exactly what an institution is often very difficult. But you're right. During the global financial crisis, we had this subprime mortgage bubble. Uh, there were banks that were lending, and that's why some of the banks got in trouble when the bubble burst. But there were also investment banks that were into the securitization process. So they held some of this, they sold it to some people, they bet on some of the derivatives, and you got some of these exotic things, the CDO squared and things like that. So there was lots of things going on. It involved banks, it involved non-banks. Um, Nowadays, it's I wouldn't say it's the same non-bank players. Most of the investment banks are now within a bank holding company. In the United States, for example, Goldman Sachs is a bank holding company. So, and they are regulated by or supervised by the Federal Reserve Board. In other places, I don't want to say it's still complex. I had a firm that I was speaking to a few months ago, and I was sort of referring to them as a hedge fund when they came in, and they're like, "Well, we don't actually like that term. We're an alternative asset manager." And I was, "Oh, okay." And because now they do private credit and they do other things, so it's almost like a bank holding company. They have, well, yes, they have the hedge fund business, they have this business, they have that business. So there are complex institutions out there, and I can't say that I completely understand their business model in a lot of cases. But it's always evolving, it's always changing, and it always will because circumstances change and things change. There's innovation, so it's important that we keep up with it as best we can.
And now let's talk about these alternative asset management firms. I guess we're mainly talking about private funds, so private equity, private real estate funds, but in particular private credit, and that is really what has been growing a huge amount. So not only they're taking money from all the institutional investors that would normally allocate to institutional products, they're taking money from insurance companies. In some instances, they're buying insurance companies and running kind of the Berkshire Hathaway model of having an insurance company and then using that float to invest in assets. But this time, they're investing in kind of in their own assets. They are, buying, typically somewhat riskier products like private credit loans. There's now rating agencies that are rating these deals as investment grade, even though these deals historically when we weren't rated at all. Maybe that reminds you of 2008. So yeah, let's just really hone in on private credit. And yeah, what have you made of the remarkable, and I say that neither in a positive nor negative way, but just it is to be remarked upon, growth of this private credit asset class? And what, if any, are your concerns?
So let me flip it around and actually talk about the positive for once. I mean, when you're Secretary General of the FSB, you're always thinking about the tail risk, but and I don't want to be accused of only thinking about the negative. So there are positives here. When you get diversity within finance, different places that people can go, that's actually a good thing, presuming that it's all prudentially regulated. So the fact that somebody who used to get lending from some place who doesn't have it can turn to somebody else, that could actually be a positive. So I think that's good. And we need finance. We need finance of all sorts because there are so many different types of investments. People want different things. Now, if I put my negative hat back on, I think there are a couple of things that I would highlight at the beginning. First, as we've harped on the transparency, it's a different group of people lending. They have different experiences, and often they have picked up the slack. And what slack is that? Well, the banks used to lend to somebody, but now they don't. Well, who have the banks stopped lending to? Well, most likely riskier lenders. So you now have the riskier borrowers going to these alternative sources. So that's good. We're continuing to provide finance, but I have some questions in my mind. Are they handling it prudentially? When things unwind, do they have the proper safeguards in place to guard their own investors? Are there things where they are going to need cash? Are they going to have to sell off at some point? Are they valuing those assets properly? When somebody comes in and says, "Well, I'd like to invest or something," are they giving the proper valuation so that the person knows, what I'm investing in? So there's a lot of questions there. So their lending tends to be to riskier borrowers. They're not as transparent, which leads to lots of questions about how this would play out if things turned against them. I'm not saying it will be bad, but as somebody who would like to understand better the vulnerabilities of the whole system, I just don't know. And people always tell us, "Oh, trust us, we're taking care of it. We would never be caught, unawares." But financial firms are always caught unawares. Every time we have a crisis or a period of turmoil, it's because some firm that thought they were doing things prudently turns out not to have been doing it as prudently as they thought.
Right. And you say, okay, diversification is a good thing. And now borrowers, they have a wider pool of borrowing. I agree with you in principle, but I might push back, and I'm open to being wrong. Don't be afraid to push back on me. But I actually think that in the U.S., the high yield, publicly traded high yield bond market has actually shrunk. So if the diversity in terms of, I guess, the stock of credit assets has been diversified, but if you look at the flow, actually, like more than 100% of the flow has been moving away from high yield. The high yield market has been shrinking, and the private credit market has been growing. And I'm speaking to a alternative asset manager next week, and I'm very likely he will say, and I will say that the high yield market has to some extent been de-risked because a lot of the riskier deals have been refinanced out of private credit. So you talked about the positives, but I'm sure you read that Bloomberg report about two alternative asset managers would have a loan to the same firm, and they're marketing each other at different levels. Like, what are your concerns here?
So first, I just have to say that usually people are so happy when I point out a benefit, and you've called me on the benefit that I named. So I'm usually not used to getting called on the benefits. Um, how does this play out? I mean, I'm going to go back to my trope about the fact that I just don't know because I don't understand the vulnerabilities because I don't have sight into them. And when I say I mean the FSB, its membership doesn't have the sight into them. Hopefully nothing bad happens. Suppose a recession comes at some point or some market shock comes, and we see that the people that are now lending money to these borrowers, they were properly prepared. They had anticipated losses of a certain amount. They have in place safeguards. So I think there's less runability. People can't call in the investments they've made in private credit firms as quickly. That's a positive thing. So maybe this all works out. But I think it's hard for us to say that with a great deal of confidence because it's happening in a space where we just don't have the visibility. We can't see how things would play out. Again, I hope I never have to test this theory. I hope that it grows and it becomes a regular part of the system and we say, wow, this is a great development. Less runnable, but other borrowers can now get more access to it. It's only the investors who can take this amount of risk. Maybe that's a good thing. Maybe this reduces the probability of crisis. But again, I just don't know. There could be a shock out there that's just waiting to happen that will, unfortunately, every time one of these shocks comes along that hasn't come along before, we learn about a vulnerability that just wasn't apparent to us.
And do you have any concern about the fact that a lot of the money being lent by so-called private credit is to private equity companies so that they can pay themselves a dividend? Do you know what I mean? And also the fact that I have an alternative asset management firm, you have an alternative asset management firm, and we both do private equity, we both do private credit. My private credit firm lends to your private equity firm, your private credit firm lends to my private equity firm.
So, I've read some of these same stories, but you and I are reading the same stories because my members and myself, we don't have insight. So how do I find out about this stuff? It's because a reporter finds out that some circular transaction took place. I don't know how common that is. If it's really common, then that's strange. Hopefully they would have some sort of good explanation, but because we're learning about it anecdotally as opposed to a regulator saying this is an issue that we've got to address, that's a little bit concerning to me because maybe it's common, maybe it's not, maybe it's just one time and we just heard about this unusual transaction that took place.
So your call to the private credit alternative asset management world is for greater transparency. How has that call been received by the alternative asset manager world? And like, let's say I'm John Schindler and you're the CEO or CIO of some big alternative asset management firm. I just said everything that you wrote in the report. What's your reaction?
It's interesting. So they don't want to reveal to anybody what they have, right? They're going to say that this is proprietary information. If I reveal this certainly if I disclose it publicly, people are going to know my position and they're going to know how they can compete against me. So I actually fully agree with that. They should not be publicly disclosing some of this stuff, but confidential disclosure to an authority could be reasonable. You might find out that you are the next Archegos, ready to break because you've made a bet that's just way too big, and maybe you've deceived who your borrowers are about how much you're borrowing and what position you're funding. So some sort of supervision, some sort of regulation in place seems prudent to me. But they're going to push back against that. And I understand the public disclosure is one thing, but the disclosure to an authority who can then assess that there's not a threat to financial stability seems to me something I would then tell them I would push back against them on.
Why do you think that they don't want transparency, other than the reason they don't want their competitors to take? Do you think there's a fact that if it was revealed, the Federal Reserve, the SEC, the BIS would say, "Hey, wait a second, maybe you need to calm down a little second. Stop growing at 30% a year."
We're talking about the unknown unknowns now, right? Why
Yeah.
won't they reveal it? I can't answer that question per se. What I do is I point to these episodes where, LDI, Archegos, etc. A shock hits, something happens, and we learn that there was a risk in the system, excuse me, a vulnerability in the system that we didn't realize. Now, we talk to these people. We know that they try to very carefully, assess their own portfolios and assess against a wide range of risks. But, ultimately, they're not sitting there saying, I should take financial stability into account because if I have to unload this position, that's going to affect other people. They don't think that way. They're thinking about their bottom line. And there is that public good of financial stability that I and others and the FSB membership are in charge of making sure that we provide to the global economy. So I get their position, and they're focused on their profits, but I have to think about the public good, and they don't. So that's why we step in when we do.
You said that the run risk is lesser than in the banking system, but could you give any color? And if you can you give any color on just how much less that run risk is? And is it, literally it's a 7-year lockup, and there's we're going to have a lot of time to weather this financial crisis that we have, so don't worry, versus, actually there's actually a ton of borrowed money that is somewhat hidden, or it's disclosed but it's not really disclosed. Just, and if you can't because we don't have the disclosure, just share us your color of what your sense is, as well as what your reaction to that is, because I know a big highlight of private credit maybe 5 to 10 years ago, a selling point I should say, not just to investors but to financial stability people like you, don't worry, is we're not leveraged. The banking system is leveraged 10 to 1. We're leveraged 1.1x to 1. But as I learned from Fabio's paper, let's call it, the leverage has been increasing, and you see huge asset firm deal. They just raised a $35 billion fund. $20 billion of it is equity, and $15 billion of it is loans. And those loans are obviously coming from the banking system. So, is it correct to say, and I believe it is, so you tell me, that the leverage in the private credit ecosystem is going up and up and up and up and up, and in a slow but steadily increasing fashion? So yeah, just talk about that run risk as well as the leverage, because your whole report is about leverage in the private credit system, and how kind of the selling point was, we're not levered at all, to actually we're quite levered.
On the run risk, I think that the run risk is considerably smaller, at least from a first glance. We don't collect the data, and I'm not aware of any of our members who collect the data on all the terms of different private funds, but maybe somebody is collecting that data. And whether there are exemptions, whether they can get people out if they want to get out, I don't know. But there's a lockup period, and that lockup period tends to be pretty substantial. So in that sense, run risk tends to be much smaller, I would guess. And then the second question was on
leverage.
The leverage. And there again, I'm dealing with the same anecdotes that you're dealing with. There's no collection that I'm aware of the overall leverage in the private finance space. I see the same stories that you do, where they say, it used to. I've been in the same conversations where they say, like, look, we're not leveraged, we're very prudently leveraged, that sort of thing. And then you hear exactly, it's always this big, no matter, I'm 450 to 1. I mean, this is it, but I don't know. I can't tell you that it's grown steadily over time, because I don't know. I don't have a way of tracking that over time. I have the anecdotes that come out from time to time. And in some cases, I don't even know how accurate it is, because if a firm puts out a story, I don't know whether what they're telling me is true, or whether it's only showing me one part of the deal. I just have no way of knowing.
And John, when you tell me, I'm a podcaster and you're the general secretary of the Financial Stability Board. When you tell me that I'm reading the same stories as you are, basically you're saying that I don't have that much more information than you do. Would you agree that that is a problem? The fact that someone who should be having the data as a regulatory authority, or who gives advice to regulatory agencies around the globe, has as much information and is just reading the Bloomberg articles like a macro podcaster. Would you agree that that's an issue?
I'm going to double down, because it's not just an issue for me. It's an issue for my membership. And my membership is the central banks, the finance ministries, the market regulators across the globe. We created a non-bank data task force precisely because we were having issues where we cannot assess the vulnerabilities because we don't have the data. If we have an idea that there's a vulnerability, we can't even calibrate the policies that would be necessary to mitigate it because we don't have the data. So the FSB created the non-bank data task force. It's currently chaired by Andrew Bailey, who's also our chair of the FSB, precisely because of these issues. So it's not just something that we should be worried. Our members broadly, we have 70 members from our global membership. This is a big part of our work going forward.
And I know, so the bank regulators, there are quote unquote only three: the Federal Reserve, the FDIC, and the OCC in the United States. But I know in the insurance industry, part of the reason the insurance industry kind of benefits is it's a state regulator, so it's 50 different regulators, I guess, on the insurance side. But in the world of private credit, who is the regulators? I heard on a podcast a CEO of a very prominent alternative asset management firm say, "Oh yeah, I'm talking to regulators all the time. I'm in DC all the time." Like, who might he be speaking to? Who is it? The SEC, the CFTC, the Federal Reserve? Who is the regulatory of private equity, private credit? Is it the SEC? And how much teeth do they have?
That answer is going to be really tricky. Again, I have 70 members, so globally. In the United States, I would assume that if an insurance company is engaging in private credit activities, their state regulator would be involved. In the United States, you also have the Federal Insurance Office, and NAIC is the collection of all the state, so they would probably be involved. I know that there are some rules for private equity firms. I think they have to be registered with the SEC. So, but what level of regulation and supervision they have after they register, I don't know the details of that. So that's going to vary from country to country. And some countries might already have in regimes where they have specific regulation or supervision of firms that are engaging in private credit. But globally, I don't think there's a lot of consistency about that.
And what about in other countries, maybe where you are in Europe? What, can you just broadly describe I know it's very heterogeneous, obviously, but the color and the nature of the regulatory apparatus? And maybe you can, I guess, complement by individually, like what is a country that stands out as, wow, actually they really have their house in order, and they have
Wow.
one regulator who organizes things really, really well.
I mean, there are a number of countries where you have sort of a single regulator. I think of like the Monetary Authority of Singapore, where a lot of the power is within one regulator. I actually don't know what they do on private credit, so that's an interesting question. They are a member, so I should probably look into that. I mean, the European regulation is probably, it's not like you would say, well, the Netherlands does it great, but Spain doesn't do it great, because they have similar rules across all of them. But our members, and I include our European members in this, are all faced with the non-bank data problem. Private credit is growing. Maybe not, I know there's a lot of articles talking about the United States is growing faster, it's bigger. But again, we don't have the data. So, but anecdotally, that's what we're hearing. So maybe it's a bigger problem elsewhere. But I haven't had a single European member come to me and say, well, I'm not worried about private credit because I've got a great handle on what it is in my jurisdiction. So I'm not hearing that anywhere. If a member is listening and they really feel like they've got a good handle on it, they should call me and let me know, because I'd love to know what they're doing.
What would you say of all the different types of non-bank financial intermediation? You got the hedge funds, you got the family offices, you got to some extent the broker dealers, ETFs, mutual fund, open-ended funds, and then the private credit and private equity. How would you sort of rank? Which are you most concerned about? Where you see the greatest risk or the greatest concentration of risk? We've mostly been talking about private credit over the past 20 minutes.
Wow. Again, that's tricky. I mean, if we were focused on a specific jurisdiction, maybe that would be easier to answer.
U.S.
Well, but I'm not going to talk about any one jurisdiction. Um, what I would say is the FSB has put out a lot of recommendations since the Dash for Cash. I would look at money market funds. Some jurisdictions have implemented those recommendations and some have not. If I'm in a jurisdiction where they haven't implemented those recommendations, I would probably be concerned. We actually have a piece that we're going to work on next year looking at the money fund, the implementation of the money fund recommendations. So something like that is how I would assess that. We have recommendation on open-ended funds. Some have implemented, some have not. We just put out recommendations earlier this year on margining and preparedness for margin calls. So I would assess it in terms of those things because we think that our recommendations would make the financial system safer. It would enable us to provide credit intermediation throughout the business cycle, which is what we need because it helps the economy grow. So I would be looking at which countries have implemented the recommendations over time, as opposed to singling out any one segment. That said, it's the non-bank sector that we're focusing on. It's the areas that are least transparent that have given us uh, I don't want to say nightmares, but the ones that make us toss and turn a little bit like, oh, I really wish I understood this sector better.
And that would be the non-bank financial sector, private credit, or that's giving you
I
costing.
would I would include private credit in there. Um, I think we have emphasized, at least in the non-bank data task force, our initial test case is going to be on the leverage trading strategies in sovereign bond markets. Sovereign bond markets are at the heart of the financial system. So if people are using leverage there in ways that we don't understand, that could be a problem over time.
Well, John, another area that the Financial Stability Board talks about outside of non-bank financial intermediation is stablecoins. Catch me up on this. I know you when we first met each other, you said that the Genius Act, which recently passed in the U.S. Congress, incorporated a lot of the Financial Stability Board's recommendation on stablecoins. What were your recommendations, and how are you assessing the risks and benefits of stablecoins, as well as what they would mean in the evolution of the financial system? Like, are they just like a tokenized bank deposit, or are they just a tokenized treasury? How exactly should people be thinking about this?
So a little bit of background is that we've been doing work on crypto assets and stablecoins for a number of years at the Financial Stability Board. At the request of the G20, we put out a framework in 2023 so it's supposed to be a comprehensive framework. We work with the IMF and others on this, on a set of recommendations for crypto assets broadly, crypto asset activities, and global stablecoins. Now, the Genius Act is one of the most prominent things that people are talking about right now. I don't know that they borrowed elements, but we look at sort of the 9 or 10 recommendations that we had, and we say, does this meet these various recommendations? And at least the way we're looking at it, most of the recommendations seem to be met, although it's still relatively early because the Genius Act leaves a lot to, I believe it's the OCC and other authorities to come up with these specific rules. So, but at first blush, it looks pretty good. I mean, the first thing we say is you have to have a regime in place to regulate and supervise these things, and that's what the Genius Act puts in place. Stablecoins in general are new. They're being used in different ways. If they're not regulated and supervised, the FSB has put out our concerns. We wrote a report on the financial stability implications of this. So I think there could be uses. The most promise is in sort of the tokenization of financial assets more broadly. A lot of people talk about the efficiency of this and enabling a greater freedom of activity. So we'll see. I don't know how it's going to be used yet, but I do think we should encourage innovation, but we should also encourage responsible innovation. We don't want people to get out ahead of themselves.
Do you think that they are going to be adopted by banks? And also, so it sounds like you are taking them, crypto and stablecoins, seriously. You're not taking the kind of Warren Buffett, Charlie Munger view, like it's all a scam.
Officially, the FSB has not said anything like that about them being a scam. So the FSB, so we started doing work on crypto assets. I'll say it was 12 years ago. Bitcoin was a young thing at that time. Um, we actually, our first public paper on it was actually on stablecoin. So even though crypto assets had been around for a while, it was stablecoin that caught the attention of our members. We called them at the time so-called stablecoins because there was no guarantee that they were going to keep stable value. Anybody could say they had a stable coin. There was nothing that would say, like, what do you actually hold? Do you actually hold one for one? Are those assets safe and liquid? If people want to get out, can they get out? So there's been questions all along, which is why you need this regulatory framework in place. When you say that you are stable and people trust that, you've got to provide on that. You've got to deliver on that. Otherwise, you're a problem. Now, crypto assets, more broadly, your Bitcoin and your others, to the extent that right now they are existing as they seem to be a speculative asset. There doesn't seem to be an inherent value there. They seem to, when people are risk averse, they sell them off. When people are risk loving, they buy them. So there doesn't seem to be a new financial asset yet. It's not clear to me what their ultimate purpose would be. Those stable coins could act as that, online version of currency. We'll see. You're right. A lot of banks are involved. A lot of banks want to be sure that they have some opportunity here. There's money to be made in stable coins. If you're holding interest-bearing assets like treasuries and offering a stable coin, that money that you're earning is going someplace and it's probably in your pocket. So I can understand why they want to use it. But I think the promise is on that next generation of tokenized assets and the ability to move assets more freely. But I'm speculating now.
Thank you, John. One of my final questions for you is about the Financial Stability Board's, I guess, procedure and the impact. So you just published this report. What is going to happen next? Are global regulators and global central banks and other regulators going to implement this? Are you in dialogue with them about how they're going to implement them? And what is your goal here? And I assume your goal is greater transparency. If you don't achieve that goal, what might the block be? Is it just these private alternative asset managers say, hey, I mean, John Schindler, I talked to him, he's a nice guy, but I don't have to share anything.
Yeah. So on the leverage recommendations, the next step is for our members to start implementing, just like you said. And the first part of that is assessing their financial system, looking at their core markets, and identifying where leverage in the non-bank sector is a problem, and then making the determination of which tools they should use. So we will encourage our members to implement over the next year or so. At some point, we will start a process of monitoring their implementation. We give people time. And in this case, these are high level recommendations. So there's extra steps in this process. But we will begin monitoring implementation at some point. And we put out reports on the implementation of all of our recommendations every year. So you'll see how we can put pressure on people that way. We also do different types of country peer reviews. We look at a country and how they're doing in a particular sector and implementing our recommendations. Or we do thematic peer reviews. We're going to do something almost like that in money funds next year. We're doing something like that on crypto assets right now. So we have some tools that we use. We actually have a big review of our implementation tools that we're just kicking off. But the other question, you were alluding to the transparency. We will continue to work in this area. We will continue to work on some areas, the leverage recommendations. We have some possible next steps that we're looking into. So we're going to have some discussions later this fall. But the transparency, we're doing this test case now on leverage trading strategies in sovereign bond markets. We're going to see if we can be effective in getting greater transparency. We don't know. This is a very challenging topic for a lot of reasons, but we're going to push hard, because if we don't and something bad happens, then shame on us. If we do and we find out the blockades are just too big, we just can't get past them, then we've given it our best shot. So we have a lot of work ahead of us in the non-bank space still.
And what do you think will happen or could happen if you and the other regulatory agencies don't start getting this data?
Wow. Well, I first off, I'm optimistic. I think we've got a great plan in place for our non-bank data task force. We don't actually necessarily need to get all the data that's not there, but if we can there could be data out there that's not being used, trade repository data. There could be data that is already collected, but the collection was done for like an investor protection mandate, and maybe that regulator could increase the mandate to use another mandate to collect other data. Maybe the data is there and it's not being shared, but it could be shared. Or maybe the data is there at one regulator. They can't share the data, but we can come with some way for them to share information gleaned from the data when it would help us prevent a financial stability episode. So we're going to look at all of those things, and I'm optimistic that we're going to make some progress. I don't know where we're going to be a year or so from now when we finish this test case, but I'd be happy to, we're happy to share our results with anybody, and we're happy to talk about the successes and the obstacles. So.
I really appreciate you coming on, John. This is a very, very important topic, and you obviously have a big say in what's going on, and is revealing the risks inherent as well as the opacity. People can find you on LinkedIn, and the Financial Stability Board's your website is fsb.org. I know, John. I'm now going to ask you to plug the FSB or any particular work, and I know there are 50 different publications and types of work that you would want to plug, but if you could just choose a handful, what should people check out other than this report, which we will of course link in the description?
We do a lot of work. Obviously the non-bank work is important. So the leverage recommendations and this work right now. We did reports. I've mentioned the crypto asset reports. I would take a look at some of that. We did reports on artificial intelligence last year on the financial stability implications. That's a very hot topic. So I would take a look at some of those things. That would be the things I would point to. Otherwise I could point to everything on our website.
Yeah. Okay. So AI, I didn't think about that with the FSB. So I understand there's economic risk of, I guess productivity increases, but everyone's laid off because the computer is so good at that. That's its own issue. But are you worried about that risk, or the risk of AI of like just the computer said sell, and it's kind of like a the Terminator movie, but instead of launching bombs on everyone, it's just like the computer presses sell at the same time, and there's a financial crisis.
Yeah, so we put out a report in 2017. Our first report on artificial intelligence was the financial stability implications of artificial intelligence and machine learning. I think that's what the title was. I think I might have actually been an author of that report 10 years ago. Last year, the G20 asked us to update that in the light of generative AI. And is this creating new risks? And I think we basically said the risks that we identified in 2017 are still there. Things like correlated trading, for example, increasing the cyber surface of your entity by using more and more, digital interfaces, third-party risk, because you're getting these vendors that are providing you things, and then that puts you at some risk that we know how to handle. I think the only thing that might have come out last year is just with large language models, depending on what language group you're in, the number of underlying models is actually relatively small. Now, you will have everybody say, "Well, I've got my own, AI model," but what they really mean is they license some underlying model, and then they've built something customized on top of that. Now, if there really are just a few underlying, then if any of them has a bug, a flaw, if any of them is hallucinating or doing other things, and then all of a sudden 10 banks, 20 insurance companies, 50 broker dealers are all getting the same bad information out of it, that could lead us to be selling at the wrong time, buying at the wrong time, not taking action at the right time. So that underlying reliance on just that concentration risk is something that struck me, at least in some of the consultations that we did. Not saying it's a big deal, but something to look at.
Thank you. And no comment on the computer sells everything at once.
Correlated trading, the computer
Yeah.
could tell if my model and your model all tells us to sell at the same time, while it might be individually good, collectively it's not good. So I don't think the computer is counting for financial stability, at least not that I'm aware of.
Right. And John, my final question, I promise, is I mentioned with private credit and private assets, I mentioned earlier that, I have been able to look through the annual reports of the big alternative asset management firms and kind of see what's going on, the presentations. But one thing I don't have access to, but I know it exists, is I will name the names like PitchBook or Preqin, or these private data providers that are supposed to be gathering all this intelligence.
Yep.
Do you think that data is accurate? I mean, does PitchBook have data that you don't have? Have you been like trying to go to alt data providers and you can't get it, or what's the issue there?
So just like all the regulators and authorities out there, we use data sources. We've got access to some of these data sets. We don't have access to all of them, but our members do. So they are using this. There are limits to some of these data sets, is my understanding, but you would take a limited data set over nothing. So we're using the stuff that's there right now. And I should say that this non-bank data task force that we're looking at, one of the things we're doing is exploring what is available publicly, what is available privately, so that we're not just looking at what could we collect. If it's already out there, we don't need to go ahead and collect it.
We'll leave it there. John, thank you so much. Thanks everyone for listening. Reminder to leave a rating and review on Apple Podcast and Spotify for Monetary Matters. It really helps the show. Also, subscribe to the Monetary Matters YouTube channel. Thanks again.
Thank you.
Thanks for watching. As a reminder, this episode of Monetary Matters is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs that give investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMHJack and SMHXJack to learn more. Until next time.